Insurance, a system built on fear, a promise of protection, a safety net sold to calm our deepest anxieties. But behind that comforting image lies one of the most profitable financial machines in history. An industry larger than most nations, richer than many empires, and more powerful than nearly any business you can imagine. Today, insurance companies do not just guard against risk. They shape economies, influence governments, and quietly decide who wins and who loses in the modern world. But how did this happen? How did a simple idea meant to protect people turn into one of the most lucrative gambles ever invented? This is the story of insurance, where it came from, how it works, and why it became so unbelievably profitable. To understand insurance, we must begin thousands of years ago, long before skyscrapers, stock exchanges, or global corporations. In the ancient world, life was fragile. A single bad event could ruin a family or wipe out a wealthy merchant. Ships sank. Caravans were robbed. Crops failed. There were no safety nets, no government programs, and no backup plans. If disaster struck, you were on your own. That fear gave birth to one of humanity's earliest financial inventions. Around 1750 BCE, in ancient Babylon, merchants traveling across dangerous trade routes faced constant risk. If a caravan was attacked, everything could be lost. So traders created a simple but revolutionary idea. If one merchant lost his goods, the others would help replace them. Everyone contributed a small amount, and anyone who suffered loss received support. It wasn't a business. It wasn't a contract. It was survival through shared risk. But it planted the seed for something much bigger. Centuries later, the ancient Chinese developed a similar system along the treacherous rivers they traveled. If a shipment was lost, the loss was shared by all the merchant partners. This turned unpredictable danger into a manageable cost. The idea spread through civilizations because it solved one of humanity's oldest problems: how to make the unpredictable predictable. But the real turning point arrived in ancient Greece and later in Rome. These societies didn't just share risk informally. They wrote it into law. The Greeks invented something called marine insurance, a contract that protected ship owners and cargo merchants. A merchant could take a loan for a voyage, and if the ship was lost, the lender would forgive the loan. If the journey succeeded, the merchant repaid the loan with interest. It was one of the earliest examples of combining finance, risk, and profit. And it revealed a truth that still defines insurance today. Where there is risk, there is opportunity. The Romans expanded this idea further. They created burial clubs, an early form of life insurance. Members paid a small fee so that when someone died, the group covered the funeral costs. What started as a community service slowly became a structured financial arrangement. The foundations of modern insurance were being built piece by piece. Then came the Middle Ages, when global trade exploded. Ships were traveling farther, carrying larger loads, and facing greater danger. A single voyage meant enormous profit, but also enormous risk. Merchants needed protection, and financial centers like Venice, Genoa, and Florence stepped in to provide it. By the 1300s, insurance contracts looked surprisingly modern. They listed risks, premiums, payouts, and conditions. Insurance had stopped being a mere agreement between people. It had become a business model. But the industry truly transformed in the 1600s in one smoky, crowded coffee house in London. Its name was Lloyd's Coffee House. Inside, ship owners, merchants, and wealthy investors gathered to gossip about weather, pirates, trade routes, and naval battles. Soon, men with money realized something. Instead of betting on horses, they could bet on ships. They began writing their names under ship insurance contracts, promising to cover losses in exchange for a fee. Each investor took a share of the risk. If the ship returned safely, they earned a handsome profit. If it sank, they paid out. This was gambling, but with the odds carefully calculated. Lloyd's coffee house eventually evolved into Lloyd's of London, the most famous insurance market in the world. And here's where insurance stopped being protection and became a gamble. Wealthy men didn't need to own the ships. They didn't need to sail the seas. They simply bet on outcomes. The house always won because they set the prices, measured the risks, and had the data. Insurance was officially a business, and an extremely profitable one. Then, in 1666, a disaster changed everything. A bakery in London caught fire. Flames spread quickly, consuming over 13,000 homes. The Great Fire of London revealed a terrifying truth. Almost nobody was insured. One catastrophe wiped out an entire city. That tragedy created demand for a new idea: fire insurance. Entrepreneurs rushed in. They created fire brigades, offered protection plans, and built companies designed to prevent ruin. For the first time, insurance became a household concept. Everyone needed it, and everyone was willing to pay for it. By the 18th and 19th centuries, as the Industrial Revolution transformed the world, insurance expanded into every new risk imaginable. Factories needed insurance. Railways needed insurance. Workers needed insurance. Buildings, machines, cargo, life, health, every invention created a new fear. And every fear was an opportunity for profit. Insurance was no longer a side business. It became a pillar of modern capitalism. Here is the secret behind why insurance became so profitable. The math is on their side. Insurance companies use something called the law of large numbers. Alone, your risk is unpredictable. But when you combine millions of people, patterns emerge. Losses become predictable. Payouts become manageable. And profits become consistent. It is gambling, but with the odds stacked in favor of the house. For every policy sold, insurers calculate exactly how much they need to charge to cover expected losses, future risks, and most importantly, profit. They aren't guessing. They are using mountains of data. They track life expectancy, accident rates, health statistics, climate patterns, crime, and thousands of other factors. Every number becomes a tool to ensure they make more money than they pay out. Many people believe insurance companies earn money through premiums alone, but that is only half the truth. The real profit machine is investment. When millions of people pay premiums month after month, insurance companies collect enormous sums of money they do not need immediately. Instead of letting that money sit, they invest it. They buy bonds, stocks, real estate, and even entire infrastructure projects. While customers wait for protection, insurance companies grow wealth. Not slowly, massively. This is why some of the largest investment funds in the world are run by insurance companies. They control trillions of dollars. They own highways, office towers, energy grids, and even parts of cities. Insurance turned into a financial empire hiding in plain sight. But the industry's power goes deeper. Insurance companies influence how societies operate. They decide which places are too risky to insure. When insurers refuse coverage due to climate risk or crime, neighborhoods collapse. When they raise premiums, entire industries struggle. When they withdraw from markets, governments panic. Insurance has become a quiet but powerful force shaping the world. Yet, the story also has a darker side. Because insurance companies profit when bad things do not happen, they invest heavily in predicting, controlling, and sometimes even limiting risk. This can lead to massive inequalities. Wealthy, low-risk areas get cheaper insurance and better services. Poorer, high-risk areas pay more or get denied. The people who need protection most often pay the highest price. Many critics argue that modern insurance has turned risk into a commodity, one that benefits the powerful and burdens the vulnerable. But despite its flaws, insurance remains a crucial part of modern life. We rely on it for health, homes, travel, cars, and families. We depend on it when disaster strikes. And even when we complain about premiums or payouts, we keep paying. Because deep down, we know something. The world is unpredictable, and risk is everywhere. Insurance companies know this better than anyone. They do not sell protection. They sell peace of mind, and people will always pay for peace of mind. That is why insurance became one of the most profitable gambles in history. Unlike casinos, insurers don't need you to lose. They just need you to be afraid of losing. Today, the global insurance industry earns more than $7 trillion a year, and it continues to grow. As new risks emerge, climate change, cybercrime, pandemics, artificial intelligence, the insurance industry expands its reach. Every new danger becomes a new product. Every new fear becomes a new source of revenue. Risk is infinite, and so is the opportunity to profit from it. Yet the core idea remains exactly the same as it was in ancient Babylon. People pay a small amount so that if disaster strikes, they are not alone. Insurance began as a simple act of shared responsibility. Over centuries, it evolved into a mathematical empire built on data, prediction, and financial power. But at its heart, it is still about the one thing humans have feared since the beginning: uncertainty. And that is why insurance will remain one of the world's most profitable businesses. As long as humans fear loss, someone will profit from offering protection. That is the true genius and the true gamble of insurance. If you enjoyed this journey into the hidden history of finance, don't forget to like the video, share it with someone who loves history, and subscribe to HistoriNomica for more stories that reveal the secret forces shaping our world. Your support helps us bring more powerful stories to life. Thank you for watching, and I'll see you in the next video.